Excellent. Well, good morning, everyone, and welcome to this year's Grain Market Outlook Conference. Just to sum up, 46, 47 slides, 45 minutes. You don't need to be economists to realise that we're going to run through this quite quickly, as you've come to expect a huge amount of information that I'm going to throw at you very quickly. As the chairman said, it's all in your packs to take away with you. You might find there's a couple extra there. I've had to, in the interest of time, remove a few, because there's just so much to say this year on the outlook. Before we get into it, it's just a quick thanks to all the team. I've got the easy bit of standing here and talking you through our outlook. A lot of the hard work's already been done by all in the team, and a lot of the team are here today, so feel free to take the time to meet with them. They are here as a resource for the industry to be using. So, let's crack on. The overview for this year's outlook is very traditional. We'll take a look at the grains complex to start with as a generic overview, and then we'll look at the commodity specifics. We'll look at maize and wheat and barley, and there's no coincidence that wheat is here at centre stage on this agenda because it really is starting to become interesting as a market. Over the last 2 to 3 years, we've been very used to wheat being a follower of the big mover, which has been maize. But this year, we see that changing, and we see wheat becoming a fundamental driver in its own right. We're going to spend probably a disproportionate amount of time than normal looking at the UK situation, really given the fallout of 2012 and what that still means for the UK market, for all of the grains and how it's going to interact with the world market and what that means for prices, but of course value as well. Now, I can't really do a grain market outlook without touching on the current events in the US. As you know, there's a current partial shutdown of the US, and that is impacting the markets directly by restricting the flow of information. We were expecting a USDA report on Friday, a very important report, the October report, as it gives the first physical indication of US maize yields. However, it's not the only source of information, and markets are continuing to survive without that flow of information in the short term. We certainly would expect there to be progress over the next few days to avoid what is the big challenge, which will be raising of the US debt ceiling. Anyway, back to the grains market. I'm going to start just giving you a pretty gentle overview of the year-on-year changes in global grain production. Certainly a more normal year for both wheat and the coarse grains. The coarse grains, of course, dominated by maize, include the smaller grains such as barley. So we start by looking at the main Northern Hemisphere producer-exporters. And the big thing that we notice here is this huge year-on-year rebound in North American coarse grain productions, up over 80 million tonnes. Essentially, that's the return of more normal growing conditions for the US maize crop after basically the worst drought in 50 years. But also we're looking at increases in Europe and, of course, the former Soviet Union region as well. Looking in the major importers, North Africa and into the Middle East, domestic crops there are also slightly higher, but what we're expecting to see is high amounts of global trade as availability from the exporters is higher and prices are lower, and so those countries may be looking to capitalise on that scenario. Looking into the east, it's a mixed bag really, and what we're starting to see is the arrival of some wheat issues in some key parts of the world. And then lastly, looking towards what might happen from the southern hemisphere harvests towards the end of this calendar year and into 2013. And the key was the southern hemisphere. They may be relatively small producers, but they punch more than their weight in terms of exports. And particularly for wheat, this is an important concept that we need to bear in mind for the market this year. To touch on prices, and here on this graph there's a year-on-year comparison. On the first graph we're looking at prices and how they developed for 2012. Last year was all about the broken line on this graph, essentially about US maize and the impact of the US drought, and that essentially forced markets higher from beneath, taking wheat markets with them. 2013 is a little bit more normal, and there's some key distinctive changes. The obvious one is that there's a downward trend in the prices, basically coming about from the big increase year on year in global grain production. But there are some other subtle differences as well. Notice the widening spreads that we're seeing between the Chicago maize price here and the solid lines, which are the key wheat markets that we're interested in. This is essentially the wheat market being a little bit more proactive and trying to ration some of the feed demand away and to concentrate on the primary demand of wheat, which is to feed people. There are some emerging wheat issues. We're not in a wheat crisis, but it's just the wheat market starting to be a little bit more proactive. Also, we see some consolidation between these three wheat markets, particularly between Paris futures and Chicago futures, as we see more equilibrium between US wheat supply and demand, European wheat supply and demand. And that's that's been a long time coming. In the last few years, it's been about a heavily stocked US wheat market and relatively tight supplies of European wheat, and that's caused some divergence between those two futures markets and created actually some arbitrage opportunities. Looking at the makeup of global demand, 2013-14 is expected to see a return to the global grain demand growth trend. 12-13 was all about demand rationing, high prices, rationing particularly with feed grains. This year with higher availability and lower prices, the expectation is demand will recover to the trend line. There's a little bit of uncertainty around that. Can, after a year of severe rationing, the demand profile return to normal trend levels? And it remains to be seen. It's a source of uncertainty. So now we head into the commodity outlook, and we start by looking at maize. Maize remains important. Maize will always be important. It's the world's main feed grain, and so it's always going to have an influence on global pricing levels, even though in the UK situation we're not a huge producer. We're an increasing consumer of maize, particularly this season. We'll come on to that a little bit later. But certainly it's a big influence to be aware of. And it's likely that maize may well be less influential on wheat prices this year as we see a rebound in maize production and maize prices moving lower away from the wheat market, but it's still important to bear in mind. Let's start by looking at the traditional supply and demand, and those who are regular at this conference and regular receivers of our material will be familiar with this analysis. Essentially, the green bars here represent global maize production, and you can see for 2013-14 how that is expected to rebound, essentially driven by more normal conditions in the US after last year's drought, but also more normal years for the European maize crop, although harvest is slow to get really into full swing, and also better prospects in Ukraine. Against that slightly is lower Southern Hemisphere production, particularly from South America, and Chris will touch on some of those, the drivers of that, I'm sure, as soybeans look like a more profitable enterprise for South American farmers this planting season. Demand as well is expected to increase in line with that more on trend as the world continues to demand more feed grains, principally because as wealth grows and the demand for animal products grows with that. The key caveat to really the maize market, although the presence of a potential surplus has put downward pressure on prices, the feed grain market actually remains relatively delicate in the grand scheme of things. The black line here looks at the stocks to use ratio, and we've been used to that trending lower in recent years. The surplus expected this season raises the stocks to use ratio slightly higher, highest level since 2009. 10, but historically remains quite tight, and really to make the global feed grain market comfortable, we need to see surpluses in 2014, 15, maybe even 16. So there's a lot of risk that still remains and a lot of potential for volatility within that. Touching on the main exporters of maize, the maize market is quite concentrated in terms of exports to a few key players, and traditionally, as the two blocks of bars on the left-hand side of this graph shows you, we've been used to maize exports being dominated by the US. 2012-13, because of the US drought and because of good production in Brazil, the US actually fell to the world's second exporter. But this season, in 2013, the US is expected to regain top spot as the world's number one exporter, facilitated a little bit by lower crop prospects for Brazil. However, the scenario is changing. The world feed grain market is evolving. No longer is the US the dominant force in the world feed grain market. It's being more evenly matched by what's happening in South America, and to an extent, the export availabilities from Ukraine. That's a potential threat to transparency in the global feed grain market, essentially because the US is the most transparent market, grain market in the world. And so if you start moving dominance away from that, you start to introduce some uncertainty and the possibility for further volatility. But it remains important, and so this is why we'll quickly touch on the US maize supply and demand. It's still a big influence, and it's one of the big price drivers this season. We've touched on production. This is based on September data from the USDA. We were, of course, expecting to have the October report on Friday, the key report looking into those US maize yields. And anecdotally, we're certainly picking up that yields have been better than expected. So one might expect there to be a greater supply of maize once the USDA publishes their next report and a more ample supply of maize from the US. In line with that, we see increases in demand, particularly in the US. The recovery in animal feed demand, not necessarily driven by the ruminant sector. We know that we've got relatively low cattle numbers in the US, but more driven by the pig and poultry sectors of the US. Ethanol demand in line is expected to increase year on year, but certainly we're not expecting to see ethanol production using record amounts of maize in the US. Essentially, the US ethanol industry has hit the blend wall. US drivers are driving fewer miles, are driving more fuel-efficient cars, and so the demand for ethanol at the current blend rates is restricted, the blend wall. So the demand for ethanol remains quite restrictive, and there's lots of lobbying going on to try and raise that level to 15% to support the ethanol sector. We can't really touch on maize without talking about the funds and the speculators. Again, this is a traditional bit of analysis that we'll pull together. The green bars represent those that have gone long on US maize futures. The blue area represents those that have gone short. The black line is the net position. And as the prospect of a better crop has been coming forward in 2013, that black line has become more neutral. What's interesting is, though, it's not the longs really reducing their position, it's the shorts increasing theirs. And so we still have an element of fund involvement in the underlying world feed grain market, and there's still likely to have an influence should there be a shock to supply. Touching on the longer-term dynamics of the maize market now, and this pie chart is looking at the share of the harvest area in 2013-14, and we're used to very much seeing area dominated by US, China, and to an extent at Brazil. But to get the full production picture, we need to have a look at the yields as well. And the US is somewhat of a yield leader when it comes to maize yields. We've had basically 2010, 2011, 2012, where US maize yields performed below trend. 2013 is looking like it's going to be the first year since 2009 that US maize yields have been on trend, basically because of more normal weather conditions and really emphasizing the use of more technology as well. China, for instance, as well, although has a very close area to what we see in the US, has nearly half the level of yields. And this is where a lot of the future production potential, to my mind, comes from as we see an uptake of technology. And it's great to have Sylvia here to give us the inside view of China becoming a much more important market globally, particularly this year as we see greater import requirements. From South America, the yields are generally increasing as well. The gradual uptake of GM technology is still going to be supportive of that, and Ukraine generally increasing as well. But what we're seeing is they're still lagging behind these US yields, and really the yield potential is there for future production needs. The EU there for reference within the mix, and there's a long-term debate about GM and everything here, which I'm not going to start today because we've got a lot to get through. But just one note on that, what we've seen in the US is GM presence for nearly 20 years, and it continues to evolve. Just like conventional plant breeding, GM has to evolve because nature will always find a way of getting around what selection pressures there are in place. The interesting bit to me is the section at the bottom of these graphs. It's the usage of stacked gene varieties, basically the next generation of GM technology, moving from just using one gene transformation to using multiples in one variety. And this is a big step up in 2013. And this is, to my mind, the arrival of drought-tolerant varieties now from the likes of Monsanto and DuPont. So what we're starting to see is drought tolerance starting to be a key feature in GM, and that's clearly the best, a very easy thing to be selling a US farmer after the worst drought in 50 years in 2013. So developments are still happening. Just crack on. Touch a little bit on South America. I'm not going to look at the estimates at the moment, but certainly the emphasis is that South American feed grain availability will be lower in this season, essentially as farmers opt to grow more soybeans. I'm sure Chris will touch on this. And why is this? Well, because we can look at the price ratios. Essentially, this graph is showing the ratio between soybean prices and maize prices for May delivery, essentially the market that South Americans will be looking at. And essentially, the ratio is very, very high for this coming May, basically at the beginning of the South American planting season. So this is a huge influence upon what South American farmers will plant. Moving out of the maize summary now, you've got the summary. I'm not going to go through it now in the interest of time, but you've got it to digest in your own time. We'll move into to talk about wheat. Wheat is really becoming interesting, really for the first time since the Russian export ban in 2010. Since then, it's been a boring follower of maize, but when it's active, when there's fundamentals going on in the wheat market, it is much more complex because you have a much more diverse number of producers, exporters and importers than you do with maize, but also you have a huge range of quality grades, each a commodity in their own right, and so that creates quite a complex grain market. To start with the headline, supply and demand, the green bars here in the production show the world is expecting a record crop, but that is equally being matched by strong demand also. Remember we looked at the price graphs before and we've seen these widening spreads between wheat and maize. That might serve to ration some of the wheat demand this season, try and ration basically the luxury element. The wheat market has two elements of demand to my mind, the sort of the core demand, which is to feed people, and sort of the secondary or the luxury demand, which is to feed animals. And what the market is doing at the moment is sort of putting these price spreads in to sort of try and ration out some of this feed demand to try and preserve some availability. And looking at this from a stocks perspective, you can see in 2009-10, the stocks-to-use ratio peaked at 30%. Since then, we've been talking about the market becoming less comfortable as that stocks-to-use ratio has gradually been eroded. This is the first time, really, since 2007, we can talk about the wheat market starting to tighten a little bit. It's more the market being a little bit proactive rather than the market being tight now, but it's just an early warning shot that the wheat market is starting to become a little bit sensitive, and particularly sensitive to any weather issues that may well occur next season. From a production point of view, a quick round the houses view of how production is shaping up. Europe will touch on it in a second. Canada, an interesting year, record wheat crop for Canada, but that comes at the expense of quality. Higher than expected yields seems to have diluted some of the protein, and also some of the baking stability of Canadian wheat is under question. The Russian crop expected to see quite a jump year on year, by no means a record though, and of course we're still waiting for around 15 to 20% of the Russian wheat crop to be harvested. The spring crop in Siberia, it was a late spring, the crop was delayed, and so there's still a bit of uncertainty around the fringes about the total level of production. Also with the Russian crop, there's an element of uncertainty around the quality. Analysts will call it disappointing quality rather than a quality disaster. Ukraine also seeing year-on-year growth, a very good year for Ukrainian grain production this year, and really demonstrating what the country is able to do. The uncertainty comes from with Ukraine is getting the consistency of production, and that's a source of volatility as the world becomes more reliant on grains out of the Black Sea region. With the US, it's a reduction in the crop this year because of key issues falling out from the drought of last year, very dry autumn and some very severe late spring weather which impacted crops, particularly in areas such as Kansas, the biggest wheat producing state. India down year on year, we'll touch on India a little bit, and China as well. We normally refer to China as a sleeping giant in the world wheat market. If you sort of discount the EU as a whole, China will generally produce and consume the largest amount of wheat of any country, but generally doesn't have an impact on the market because it's generally trade neutral. What we're seeing is that trend being broken. China is very much a part of the global wheat market now and is a big driver behind that. Looking to the southern hemisphere, and as I mentioned before, the world has expectations or has a reliance on crops from Argentina and Australia, a relatively small part of production, but a much larger part of the export matrix. So a reliance on that, particularly as we have crop issues occurring. This slide is one of the key ones, really. It's one of the key takeaways to understand what's happening in the wheat market this year, and it really sort of demonstrates how trade has changed. The yellow area there on the slide, Egypt. Egypt's the world's largest importer of wheat, and generally what happens in Egypt, or who Egypt buys from, is a big influence on price. It's still an important factor to bear in mind, but it's not the only factor we need to bear in mind in terms of global wheat trade. China this year has virtually come out of nowhere to basically be forecast to be the third largest wheat importer in 13-14 because of domestic quality issues. the highest level of Chinese wheat imports for 18 years, which is absolutely astounding. And so we're going to look at that in a little bit more detail, hopefully with Sylvia. But it sort of represents really the much higher requirements for imports of grains this season for China. Brazil is also an interesting driver as well. Not that it's changing in its rankings very much, but it's changing where it's sourcing its wheat from. Last year, Argentina had a big quality issue, big production issue with wheat, and as soon as the US new crops become available, Brazil has had to start sourcing wheat from the US to get the availability that it needs. This is the next sort of big sort of takeaway message for you on the wheat market, and this sort of explains why the wheat market is becoming more proactive. The interesting thing here to look at are the green bars. This is essentially looking at the evolution of the US wheat stocks-to-use ratio. Back in 2009-10, the US had some big surpluses of wheat, as did the world, but the US simply couldn't compete on export markets. And so we saw the accumulation of stocks. Since then, we've seen this gradual decline in US wheat stocks-to-use ratio. But US wheat has essentially been there as the world's guarantees, the world's insurance policy, because you know that US wheat stocks are exportable, they're of a known quality, and there's not going to be an export ban in place. So it's almost a comfort blanket. What we're seeing this year, though, is a sharp reduction because of this additional demand for US wheat from China and Brazil, and a lower US wheat crop as well. That's actually eroding stocks away out of the comfort zone, and so US wheat stocks are they might start to tighten. So certainly not in a comfortable situation, and this is another warning shot to the world wheat market that needs to start being a little bit proactive and not being such a follower of what we see in the maize market. We can demonstrate sort of the trade situation at the moment. This data is only up to the end of August. Unfortunately, with the USDA shutdown, it's very difficult to get weekly trade stats at the moment, so there's a bit of a loss of transparency at the moment. 3 weeks now without US weekly export inspections, and so that's may start to accumulate some concern. But we can see year on year just the impact that Brazil and China is having on US wheat trade. I'm going to move away now from talking about the traditional sort of trade areas and start talking about India now. India last year sort of started to have a presence on the world wheat market because of an accumulating surplus of wheat and the need to start exporting. In India, as demonstrated by this green line, there's a minimum support price. And if we were to look at this in rupees, this is in dollars per ton, but in rupees, it's an escalating minimum support price to encourage production. Now, as a result of that, there's a cost to the Indian government, represented by the black line here, and that cost is above the minimum support price because there's an element of losses, inadequate storage and quality losses and quantity losses as well. And as a result, what the Indian government have in place is a minimum desired export price of $300 per tonne currently, below which they're not willing to export. When we overlay this with the market price, we can say that the market price is beneath that desired export price for India. So it's very unlikely that we'll see India really being a big player on the export market unless we see further increases in wheat prices or we see a policy revision. So it's unlikely that we're going to see India sort of dominating in the wheat market. Into Europe, and this is the supply and demand estimates as published by the Commission, an increase in production as we touched on before, and slightly higher demand, but it's the exports at the moment which have the focus, and it's really the pace at which export certificates, export licenses are being granted. They're not a direct correlation with physical exports, but they give us a pretty good indication of what's going on. If we consider that at the moment the EU Commission forecasts that the EU will export 18 million tonnes of wheat against 20.3 last year. If we consider that at the beginning of October, around 7.7 million tonnes of export licenses were granted out of the EU. That represents 43% of the total surplus, or the total export forecast. If we compare the 43% against a year ago, which was 21%, so very, very rapid granting of export licenses against what is a relatively small surplus. So it may well put pressure on the export estimate to rise as we go through the season. And that's important when we consider the stock situation, the stock-to-use ratio in the European wheat market on these diamonds. We've been very much used to Basically, the big surplus of wheat in 2008-9 gave us a stocks-use ratio of close to 15%. We fell to below 7% last season, expected based on the current estimates to see a recovery this season, but it's a relatively small recovery and comes into question if exports get revised higher. So European wheat, although seeing a slight recovery in stock levels, still remains relatively sensitive. Around the house's trip of sort of European wheat market at the moment, and for the two main exporters of wheat, France and Germany, we've seen production higher. This was the initial bearish drag on European wheat prices, the prospect of higher production, and it hasn't been without some issues as well. Certainly one of the main issues has been the prospect of lower protein in French wheat. 34% of the French crop is seen to have protein below 11%. That's basically a big increase from the 18% last year, and also about 12% of the crop is seen to be of feed quality, similar to last year, but typically we would expect less than 10% of the French wheat crop to be of feed quality. That has implications when we start to consider the UK situation. Germany is really interesting because what we're starting to see is a high quality protein issue developing in around the world, and Germany is very good at producing this high quality protein. So there's been a huge demand, export demand for German wheat, and that's been a big driver. If we consider the main sort of internal customer or the internal trade partner is Spain, a big increase in domestic production. Again, that was a big bearish factor threatening the decline, threatening sort of the ability for internal trade for wheat in the EU. If we move further to the east and we consider what's happening in Romania, Romania is a key European or EU exporter now and really managing to compete with the likes of Russia and Ukraine, and has won a great deal of business to Egypt. But there is competition out there, particularly from the Russian crop. There are quality issues in extent. There's the completion of the harvest to be seen first, and there's uncertainty over when the Russian government will begin its intervention buying and how that will respond to the current increase in prices that we've seen in the last few days. Ukraine, a very good year, as I said, for Ukrainian grain production, but what we might see from an export point of view is a prioritisation of maize exports, and so that may limit the ability of Ukraine, a logistical limit in terms of how much wheat can be exported. I'm going to move out of the wheat section now. There's the summary there for you to take away, and as I said, wheat is becoming more interesting. It's developing its own fundamentals in its own right, and so it makes the market analysis much more advanced rather than really just being a follower of this big maize commodity. Moving into barley, and what we need to appreciate with barley is that it's a relatively small crop in the global scheme of things, and so it's still going to be a follower of these big changes that we see driven by maize prices, driven by wheat prices. But we can sort of set the scene a little bit by understanding the global supply and demand. So really, an increase in production, essentially the first global barley surplus since 2009-10. In line with that, demand has increased. But as we've seen with maize, the stocks-use ratio actually remains relatively delicate, and that's quite important when we look at this from a UK perspective. The UK has a big barley crop this year. The UK will have to compete for third country exports to balance the supply and demand. So what is happening in the global barley market is inherently important to the functioning of the UK market. Now, again, around the house's tour of what's happening for the main world barley producer areas. We'll touch on EU shortly. Production is seen slightly higher, but exports lower. The Canadian crop is seen higher, but with high domestic demand and rebuilding stocks from a relatively low base, there's not expected to be a huge amount of change in how much barley Canada exports. The key starts to come from the former Soviet Union. Let's have a look at Russia, an increase in production and an increase in exports. That's going to be quite important, and also Ukraine as well. Although production is higher, exports are likely to be, or currently forecast to be, static. Maybe this prioritisation issue of maize at the ports rather than worrying about wheat and barley so much. From a southern hemisphere perspective, we need to appreciate that there are potentially good crops coming forward from Australia and Argentina, and this presents a challenge in that if we've got barley to export to third countries, would it be better to do it sooner rather than later when we've got this additional competition coming in from Argentina and Australia as well, which will bring some supply relief to the market and may well make the market a little bit more competitive as well. On the import side, because we've got a build-up of stocks principally in the Near East Asia region, although availability is higher and prices are lower, trade in barley is expected to be a little bit lower this year because of higher stocks, but also we're seeing some diversification away from barley. Saudi Arabia is the biggest barley importer, clearly buying a lot of feed barley, and we're starting to diversify, looking at other feed grains such as maize, such as wheat in some instances. So price competitiveness becomes a real key here. Again, we see this China trend continue in the barley side, an increase in barley import requirements. That's a key feature. Looking at the European barley supply and demand, again from the EU Commission as we've looked at wheat, and in similar vein to the wheat, we've seen an increase in production, fairly static demand, but again, the development lie within the exports. If we look at the export certificates as a proportion of the season total estimate or forecast of exports, then we can see that the export licenses cover 64% of that current of the full season estimate against 24% a year ago. So it's likely that there's going to be pressure for that export estimate to rise, and as important is looking at these stocks-to-use ratios and looking at this in the context of the UK's barley crop this year. The last time the UK had a sizable barley crop was 2009, driven by, again, strong spring planting after the back of a wet autumn. There we had barley stocks-to-use ratio across Europe over 30%. This year we're down at around 15%, maybe lower if this export demand continues. That's a really important feature that we need to bear in mind when we're thinking about how the UK barley market is going to balance itself. From a prices perspective, what we've seen from these prices, looking at European export prices, principally out of France and UK, and in the last two seasons, so 11-12, the malting price support came from the premium. That was 2011. 2012, the malting price didn't actually change very much, but the support of that price did. We saw a huge uplift in the feed-based support, but a very, very thin premium. Coming into 13-14, we've lost a lot of the feed barley price support because of the global feed grain market, that increase in maize production, which has undermined feed grain prices. There's some support at the European level for the premium, but certainly at the UK level, that premium is going to be being squeezed due to the big supply of barley that we're looking at. Here's the barley summary to take away with you. It's fairly self-explanatory, so I'm not going to go into that with you now. The last part of the presentation is really now looking at the UK scenario. Phenomenally interesting, challenging year for the UK grain market. And what we're very much used to is all of the price direction really coming from the global market. What's been apparent, because the UK's had in the last couple of years to move from net exporter to net importer, the UK situation has actually had a direct impact on price, albeit relatively small against the grand scheme of things in terms of global price volatility, but certainly an important one to watch out for. Now I'm going to start by looking at the UK wheat supply and demand. This was published yesterday, and we can see the table here for you to take away the key stats from that. I'm just going to build a graph here just to really try and illustrate to you the key issue. So we'll start with building up the stocks for wheat. So coming into this season, we see elevated stock levels because last season the UK imported wheat quicker than it was able to use imported wheat, and so we saw an elevation in stock levels. That goes some way to offset a lower production. The UK this year, the provisional estimate from DEFRA is a 12.1 million tonne wheat crop, so the lowest crop in over 10 years and even lower than last year's crop. The dynamic, though, is that last year was about a small wheat crop with very low quality. This year the dynamic is different. It's still about a small wheat crop, but it's about good quality, and that shifts the emphasis. Last year's emphasis was about importing milling wheat to meet the needs of millers, and of course, millers can only really use wheat to make flour. This season, with a high quality, it shifts the emphasis into the UK feed grain market, and that's where the supply shortage is. And we know that animal feed compounders are not necessarily constrained to use just wheat. We can use barley, we can use maize, in some cases we can use sorghum, and so it changes the whole makeup of the market, and it's important to remain that. As a result, because we have good quality, there's less need to import high quality milling wheat, and so the imports are able to be lower. On the demand side, we see some rationing of demand, principally in the animal feed area, because feed wheat is becoming uncompetitive in places, being replaced by alternative feed grains. The key thing to take away here is really the black area on this graph, which is essentially the export, the sum of the surplus available for exports and closing stocks. It's a very thin level, and so it sort of keeps the UK supply and demand very, very finely balanced. And so any changes is likely to be influential on, or very vulnerable to the change in the trade balance of the UK. And so that's what I want to sort of start to talk about now, is about the UK's trade balance in wheat. Now, this is a graph that I'm personally very proud of. I think the people in my team might think I'm a little bit sad, but it's one of my better achievements of the year. This is really looking at monthly trade data for UK wheat. The green bars represent monthly imports, and the blue bars are exports. We have to look at to the left-hand side, 11-12, to get an understanding of what a normal year looks like. The triangles are the important thing here, and really, in a normal year, we see a diminishing net cumulative surplus as we export, and we export the surplus, and then it sort of peters out. 2012-13 was extreme because it was a big import year, and it became apparent from a reasonably early point that the UK was importing wheat quicker than it was using that imported wheat. However, the UK continued to import wheat, and so the triangle showed that very linear relationship, that net cumulative just kept rising and rising and rising, even though the market was aware that it was using less wheat than was being imported, leading to an accumulation of those stocks. What we have now is the data for July, the first month of the 13-14 marketing season, and that shows relatively strong imports. One would expect to see reasonably strong imports for August and September. That's essentially the UK consumers' insurance policy against the uncertainty that was the 2013 wheat crop. If we consider 6 months ago where we were, we'd come out of a very late spring, crops were very delayed, they were very patchy, we knew the area was down significantly. So there were huge question marks over what was the crop going to be, when was the crop going to be harvested, and that was even before we had the traditional debate about what's the quality going to be because of the state of the uncertainty of what the UK summer is going to be like. And so that was creating huge uncertainty. So quite understandably, there's been an insurance policy of new crop imports being lined up just to protect, just in case. Luckily this year we have the sort of always the best of a bad job when it comes to the UK crop. Good quality, and that's absolutely key. Although it's a low crop, it's a high quality crop, it's very usable, and it's a very competitive crop. Some people always ask me, why do we have to be competitive when we're not exporting wheat? Last year was a classic example of that because we have to be competitive with imported wheat. Last year, UK milling wheat was simply not competitive enough with imported German wheat, and hence millers used more German wheat. So even when we're not exporting, we're still fitting into the global wheat pricing matrix, and we're still having to be competitive, and the quality really, really helps this occur. Here's a summary of the quality data here. The bars here for GB and East of England show you the specific weights, the huge rebound from last year, really identifying that last year really was a freak year. Not to the levels of 2011, so not quite the vintage quality that we were used to then. Proteins, you could have a bit of a debate with, but the GB level have been reported to be slightly lower. I think you have to look at protein not just at the quantity but at the quality. We have much more functional protein. Last year, a lot of the protein was sat on the husk of the grain, never really made it into the flour. This year, it's much more functional. The baking quality is there as well. Looking at this a step further, and what you'll traditionally be used to is looking at the Venn diagrams, looking at the Group 1 samples, how many samples are meeting the full spec. This is a take on that analysis, and it's essentially looking at the full milling wheat profile. So the three bars on the left-hand side represent the NABIM Group 1 varieties, the 2009 to 11 average, what we saw in 2012 and the 2013. So essentially in 2013, 38% of the NABIM Group 1 samples from the provisional data meet full specification. But it's important to appreciate the full complexity of the whole milling profile that's there as well. And that's a huge leap. You know, last year just 3% of samples were meeting that. And that goes a long way to sort of explain or show that last year was really a freak year, but we've seen a real return to normality. And so you can look at the UK wheat market and think actually from the milling point of view, actually looks relatively normal considering the size of the crop we have. It just lifts up the concern, moves it away from the milling side and puts it into the feed wheat market. And that's really important when we want to consider milling premiums. Milling premiums will always be a contentious issue between farmers and consumers, and the traditional line is when we get an increase in milling quality, the milling premium declines because there's an oversupply of milling wheat. The milling premium has been squeezed from both sides this year. It's been squeezed by a good availability or good quality of the domestic crop, but then of course this feed wheat issue. Feed wheat is having to price its way out of the export market, so it's squeezing from beneath. So the milling premium has pressure from both sides. It's really important to appreciate that when evaluating the milling premium. Now, I could be quite cringeworthy here and say that because we have a feed wheat issue, the UK has a bit of a feed grain love triangle going on this year, for want of a better analogy. And that's because you could think, okay, well, we have a feed wheat issue, but we have more barley to use, so why we'll just use more barley in place of wheat? It's not as simple as that, because we know that barley has its issues. It has limitations physically into feed rations, principally into pig and poultry rations. And this is where maize comes in. And the first graph here just looks at the cumulative maize imports for some key seasons. The broken line is 11-12, really the last normal season that we saw. And some key benchmark seasons for imports, 7-8, 1-2, and 12-13, where we saw a real increase in the amount of maize imported, really to substitute feed wheat as an alternative feed grain. It's not as simple as just looking at the economics, because there's potentially some traditional approach about the type of feed grain used by compounders, so can't really explain it with all the economics. But the prospect of what might happen in 13-14, we can have a look and have an indication of prices. Now, this brilliant chart here on the right-hand side is looking at the premium of feed wheat in the UK over maize futures in Europe. Now, traditionally, that we're looking at a negative premium, or feed wheat's having to discount because we're traditionally having to fight for export competition. This year, we've moved from being some of the cheapest feed grain in Europe, some of the most expensive, because we have a feed wheat supply issue. And so essentially, it's dragging up the premium of feed wheat over maize and making it import competitive. So there'll be an element of substitution. So we should expect to see maize featuring, not replacing reams and reams of feed wheat, but certainly eating away at the margin, particularly into the poultry side. 5 minutes, please, Jack. Okay. Just to move into the barley situation, and the barley situation could not be more different from wheat. So I'll build up this graph quickly for you. Stocks, it's fairly neutral. The big issue is this huge increase in production. This is the largest barley crop the UK is looking at in 15 years. This is the largest barley crop in modern times that will not be balanced by the use of intervention. In 2009, when we had a comparable barley crop, intervention was used to balance that supply. It's unlikely, very, very unlikely, that intervention is going to play a role in balancing the supply of barley. Demand sees an increase as some extra barley can be used in the feed ration, but there are technical limitations. And how it will be balanced with this huge black area on the graph, which is either as closing stocks or as exports. And the UK has been pretty good. You know, we've seen nearly 130,000 tonnes of export licences granted for the UK, third country exports, up from 6,500 tonnes a year ago. So the market is working. The market is stimulating third country export demand. But it remains uncertain about how that split will look at, how much will be exported, how much will be carried over. If you reference, here is the GB barley quality, and a similar vein to what we've seen with wheat, that big rebound in specific weights. Again, highlighting how much of a freak year 2012 really was. To move on, let's touch on oats very quickly. We'll have oat production data on Thursday when DEFRA make their next release of production estimates. But because of the conditions that we've had, you know, there's an expectation that the UK may well be looking at the largest oat crop for over 40 years. That puts a real question mark about how the oat balance sheet will be balanced. And just the historical supply and demand here for you to take away and look at and reference. Will it be through exports? More likely it will be through a stimulation of feed demand. You've got an additional oat slide in your packs to take away, and I'll just sort of, here's the sort of the UK summary. And the key thing with the UK is that for all that's been thrown at the UK industry, it's demonstrated massive, massive resilience. And I think that's something to be proud of, the industry. It's also something to be aware of, identifying, this is why Graham's here today, to identify where resilience is coming from in the industry today, but more importantly, where is resilience going to come from in the future, in terms of if this weather issue that we had in 2012 reoccurs in 2020, 2025, 2030, what is the mechanisms by which the industry is going to cope with that? That brings me on to my overall summary now, just really picking out the generic points. Now, it's fair to say we see more normality in the global grain market, a return to normal levels of production. But given what's happened in the last 5 years, or 6 years, or 7 years, we don't really know what normal is anymore. But it feels slightly more normal. And that's given a bearish trend to prices, and that's the big driving force of lower prices. Maize it remains a key driver, and that's the big bear at the moment, although we're seeing some resilience from wheat at the moment, wheat being a little bit more proactive. But depending on what we see out of South America, or the Southern Hemisphere, Argentina, Australia, we may see some attack or downward pressure on the wheat price relative to maize. So there's a bearish threat to these prices going forward. Wheat is becoming more and more interesting. For the UK, it's all about resilience. I wanted to think very, very quickly on 2 final messages for you, just to take away. One is relates to value. We have, in the UK, or globally, lower commodity prices. But that doesn't mean that supply chains can sit back and not be competitive. Now, and competitiveness is going to be absolutely key across supply chains. Really, to my mind, driven by this. The blue line here is food price inflation. The green bars here are weekly wage or average weekly earnings. And so we're seeing a spread. Food prices continue to rise quicker than average earnings. And so food is becoming, or it's slowly starting to occupy a greater part of the household budget. And that is the ethos, or that is the driver of wanting to deliver more value to the consumer. So just because raw material prices are lower, the demand to remain competitive, the need to remain competitive and continue delivering value remains absolutely key. The second message is a little bit more traditional for me from this conference, and it returns to how we manage risk, how we manage prices. Now I'm going to make a big generalisation about UK arable farmers and how they sell grain. And apologies if you fall outside of that exception, but it is a big generalisation. What we've seen over the previous 3 years, 10, 11, 12, is a general appreciation in the grain price from planting through the growing season, through the marketing season. That's been a general trend. And that's basically played into the hands of the traditional way of which farmers sell grain. 2013 has so far bucked that trend and coincides with lower area, underperforming yields, is putting a real strain on businesses. For instance, just for interest, really, that's the 2014, and I'm not going to stand here and sort of say, in 12 months' time, this is what the 2014 price is going to be. If you want a range, you could pick a number between 110 and 100 or 210, and you might be somewhere close. That's how uncertain these markets are. And so I think in order to make the most of this volatility's been with us big style for the last 7 years. And to make the most of it, we continue to need to move away from traditional fixed pricing mechanisms to more sophisticated pricing mechanisms to essentially allow people to protect themselves and then gain potentially if the market moves in their favour. That's the way to make the most out of volatility. And it's not just volatility eating away or creating the risk, it's the underlying costs in the farm business as well. And this presents risks for the whole supply chain. This is a typical sensitivity analysis for a typical feed wheat producer. And we can see as costs have risen, we're looking at sensitivity in price and in yields here. But certainly as costs rise, the actual working capital, the cash requirements for growing that crop gets higher and higher and higher. And that increases the amount of risk and basically up the stakes of what volatility is putting at risk. So I'll leave it there, Chairman. Thank you very much for your attentiveness and happy to take some questions.
Thank you very much indeed, Jack. 4 minutes for questions. There must be some after all that. Any questions? Anybody wave your hands? We've got right in the middle of the floor here. Can you say your name and where you're from, please?
Yes, Graham Birch, and I'm a farm owner from Dorset. Jack, one of the very last slides you showed the consumer price index and the food, the average weekly earnings. I mean, I think that this is looking at it really since the start of the global recession, if you like, or a bit before it. I mean, if you took that chart back to the previous sort of 50 years, you would have seen a very, very long downtrend in food CPI versus earnings, I think, because I think that food was getting cheaper. I mean, have you got any comment to make about where we are in that bigger cycle rather than just the last 5 years?
Okay. I wear two hats in response to sort of this kind of, I wear the hat of a farmer's son, which says, well, and this isn't the view of my employer, it's my view as a son of a farmer, it's that food's been too cheap for too long and it's undervalued. And so perhaps it does need to increase to increase how food is valued. But the view of the economist is, yes, in that longer cycle, if you consider it, you get one answer. But people making their purchasing decisions, making their household budgets, don't really consider the long term. They consider what's been happening in the last 5 years. And they feel that there is that wage increases are not matching, or percentage terms, not matching increases that they're seeing in household bills. So that's going to influence their psychology of how they look for value for the retailer. I do agree. You need to looking at the long term. You will get a different answer. But in terms of how people are responding to this and what they're demanding in terms of value from the food chain, it's a different answer.
Yeah, we've got one right here in the front.
Alex Waugh from NABIM, Flour Millers Association. Jack, you quoted the DEFRA figures of a 12.1 million tonne wheat crop in the UK. How confident are you that that's right?
This is where I draw on my colleague Charlotte. Where's Charlotte? While Charlotte's getting a microphone, I mean, it's important to remember that the production numbers from DEFRA are provisional at this stage, and they are based on a statistical survey, and it is the most statistical robust survey that we have to look at production. At this point, Charlotte will have her microphone and I'll hand over to you.
Yes, I'm not sure what more you expect me to say, but yeah, the DEFRA survey is the most statistical view of production out there. It is provisional, and I know that a number of people in this room will have been running with a higher number than the 12.1. But that's what's come back, and I think the detail that we'll get on Thursday of the regional split will give us a view of really where that lower number is coming from. It's very easy to sit in a region and take a view, but actually if the survey is covering the whole of the UK, that will give us a feel for which regions perhaps have pulled down that average that we expected to be higher initially. In general, on surveys, there's sort of two parts of it. There's methodology that helps the accuracy, but there's also the data that goes into it, and you have to take sort of responsibility as an industry to put forward the right data. So there are people in this room who do it sort of on an annual basis, just from a farmer's perspective, but there'll be traders and merchants and processors who have to supply monthly data, and to get the accuracy and the timeliness of DEFRA data, then we need to sort of all take responsibility for that at the same time.
Right, thank you very much indeed. I think you've all realised where the power lies now. Jack stands up and gives you all the guff, but when he gets a difficult question, he turns to Charlotte. We haven't really got time for any more questions. Jack will be around and about for the rest of the day. On the back of his presentation are his email details and his phone number. He's always pleased to talk to people and get regional views and differing views from those that he's putting out. So please do talk to him if you've got any further questions, either today or in the future. Thank you very much indeed, Jack.